Hello, it's Robert Miner with Dynamic Traders Group with their DT Trade Strategies for the week of March 22nd. This is where we do a brief video of one or two potential market setups coming up in the next week. It's very brief. We give you the basics. Whether you trade the market that we focus on or not, it's intended to be educational video so you can apply to other markets and other time frames what you learn in this video. And we do this for our Twitter and our YouTube followers, so you get a little taste of what we do in our DT reports, which is a much more expanded videos each week, where we do not only market update videos, but we also do trade tutorial videos that are specifically to teach various trade strategies from entry to exit. If you like what you hear in these videos, check out my book, High Probability Trading Strategies. And also check out our DT reports, where first-time subscribers, there's a 1-month trial available from $19. So you might check that out if you're interested. Okay, let's get started and look at a market that's right up to date and might give us some good information to make trading decisions next week. We're going to take a look at everybody's favorite today is the S&P. And by the way, last week I did one on the euro, and that setup has not quite been fulfilled yet, but it looks like we're a day or two away from it. So all of the information that's in last week's trade tutorial video for YouTube and Twitter subscribers is still valid for the euro. So if you're interested in the euro, you might want to check that out. Okay, let's take a look at the ES. This is ES 240-minute data, and I'm showing data through Wednesday. We're going to bring it right up to date in just a moment. But as of Wednesday, and by the way, a couple weeks ago, I did one of the ES and SPX also to show how we look at potential wave counts and what confirms and invalidates that wave count. And we showed 2 or 3 potentials, and of course one of them got confirmed and another one got invalidated, and we continued to a new high as anticipated, following that one getting confirmed. So here we are as of Wednesday. As of the end of the day, Wednesday, we were in a position to complete a 5-wave advance up from the March 4th low, where the wave 5 would be what's called an ending diagonal. In Elliott wave terms, that's where you have overlapping sections where the wave 4 trades well into the range of the wave 1, etc. So as of the end of the day, I showed where we were at the price and the time, and everything was together for potentially completing the advance off the March 4th low. And if we traded below Wednesday's low, which is the wave 4 or 5 low, that would confirm that that was complete. Well, that was a pretty good alert to have, because the next day we traded below that. So I'm going to bring data right up to date through Friday. Now I'm recording this Friday about 2:30. Market's not quite closed yet, got another hour and a half to go, but nothing's going to change in the next hour and a half from where we're at right now. So again, this is going to be much more brief than what we gave, the detail we gave to subscribers, but it'll be enough information for you to use this next week to make specific trade decisions. So here we are. If we've completed the advance from the March 4th low, and it may even be a higher time frame top, but I always go for the minimums to begin with. If we completed that advance, then typically we'd make at least a 50% retracement, if not more, and that would be down to about 38.45. And typically we'd make between a 38 and 62% time retracement, and that'd be Wednesday, Tuesday into Friday. So the market, the S&P, should be sideways to down if we've completed a 5-wave advance into at least Tuesday, and should complete a corrective decline by the end of the week if we're just making a correction to this advance. So where are we at right now? Are we going to immediately go down, and what would void that potential for kind of short-term bearish potential? Well, I'll go to the, I'm going to even get down to the 60-minute data here. There's our 60-minute data on the ES through today, Friday, potential 5-wave decline. If that's the case, typically we'd have around 50-62% retracement against that 5-wave decline. And if this is a 5-wave down, it gives us a couple good pieces of information. Number one, it cannot be, or should not be, a completed correction. It could be a wave 1 array, and we'd have a wave 2 be correction, and then what would follow? Well, continuation of the trend prior to the 2 or B correction to a new extreme. That means below Friday's low. So that's why we might want to identify the conditions to complete a correction. So here's the 62% retracement, typical correction against a 5-wave trend, and 62% time retracement is Tuesday morning. So if we've made a 1 or A decline in Elliott wave terms, a wave 2 or B correction should be complete around 39.26 to 39.38, 39 by Tuesday morning. Now that's not a forecast, that would be the typical correction against this initial decline. The most important thing is we're looking to identify opportunity then to complete the correction, because when that's over, we should then continue the decline to below Friday's low and would typically reach, let's go back 240 minutes, around 38.44, if not lower. So let me take a look at the SPX. This is just 15-minute data, but we're just kind of focusing in on the decline off the March 17th high. If we look at the SPX, it just looks like in Elliott wave terms we've done 1, 2, 3. What's the difference here? Well, it's because that what I labeled wave 4 in the ES all happened overnight, and the SPX, of course, doesn't trade overnight. All of this, what looks like a wave 4 correction, happened overnight. So if we're just looking at the SPX, basically we came straight down into the low on Friday. So if this is 1, 2, and a 3, whether this is correct or how we looked at it on the ES, both of them are indicating that we should be making a minor corrective rally, which should eventually be followed by continuation to a new low. So no matter which way we look at it, the outcomes should be the same. But what the SPX does, it gives us a stop out point. It gives us a point that clearly says the immediate trend is not bearish, and we're probably not going to go to a new low. And that is if we trade above this swing low made on, what is this, on Thursday, which I got labeled a wave 1 in Elliott wave terms. It's a rule that a wave 4 shouldn't trade into the range of a wave 1. So this becomes our stop out point for a potentially continued bear trend. So it's a good piece of information to have. Also, if you happen to be short, where would you move your stop? Well, move your stop a couple points above 39.43. Pretty simple stuff. So where are we at now with if we're looking at the SPX? Well, we've made a retracement into the ideal wave 4 retracement zone, which is the 38 to 50% retracement of the wave 3. It's one of the very few situations and structural patterns where a 38.2% retracement is relevant. People that don't really know about retracements and how they work with Elliott wave patterns and all that are putting 38.2% everywhere. Well, they're really only relevant as a wave 4 retracement and 1 or 2 other special cases. Typically, we're looking at the 50% retracement. Well, we've reached that as of the end of the day. So we're not too far from what the maximum should be on the upside if the trend's going to continue bearish, regardless of whether we're looking at cash or we're looking at the ES, the futures data, is that our stop out point for a continued bear trend is not too far above the market at 39.43. So this is information that we're not making any forecasts whatsoever. We're identifying what we know about the market. We're identifying what is the probable maximum given what the probable current position is, and that then we can develop a specific trade strategy around that information. And in this case, as long as the SPX is not traded above 39.43, we want to develop go short strategies for a probable continuation of the bear trend to below the March 19th low. So there's information that you can use next week, whether you're looking at the cash or whether you're looking at the futures. Looks to me like great trade setups with minimal capital exposure and a fair amount on the downside probably to go over the next few days. Here I went back real quickly to our daily data. And we had this big down day yesterday, which was Thursday. This is Friday. We're not quite closed yet. We're actually going to probably close up for the day. Boy, a lot of people are going to get probably very bullish and say this was just a news event and we're popping right back from it. Well, if we look at the pattern, it's pretty clearly indicating we should continue lower next week as long as we haven't traded above 39.43. And we go back to the daily here. Our daily momentums are dual look back bearish. They haven't reached oversold yet. That alone indicates we should have another 2 to 3 days sideways to down, probably reaching around the 50% retracement at 38.44.50 or so. So that's our information, a little tutorial for you this week. Hope you use this information to make some specific trade decisions in the days ahead. If you liked what you heard, check out my book, High Probability Trading Strategies, or check out our DT reports, where we give you daily updates, education every week, and of course we look at all the major financial markets. Take care, stay safe, and be back with you next week.